Hey there, Mavericks. Short-term loans and long-term loans have the same basic idea: borrow money and pay it back. But that's where the similarities end. The one you choose shapes your business in a big way. One gives you quick cash and quick payback. The other stretches out for years with lower costs but more commitment. So let's break them down and figure out which type actually fits your business. Short-term loans are all about speed. You'll usually repay your loan within a few months, but some loans have repayment terms up to 2 years. Short-term loans are built for immediate needs, buying seasonal inventory, covering payroll, or fixing equipment that's essential for your business. Short-term financing includes online term loans, merchant cash advances that pull payments straight from your credit card sales, invoice financing if you're waiting on customer payments, and business lines of credit you can tap and repay quickly. The biggest upside is access. Online lenders can approve you fast, sometimes even instantly, and they don't usually require collateral or perfect credit. But the trade-off is cost. Interest rates are higher, and daily or weekly payments can hit your business hard. Short-term loans fix immediate problems, not long-term projects. They get you through the moment, but won't carry your business long-term. Long-term loans are the bigger plays. These are bank loans, SBA loans, or financing deals that run for years. They're what you use to buy property, upgrade major equipment, or fund an expansion that'll take time to pay off. Examples include traditional bank term loans, commercial mortgages, SBA 7A loans for working capital and business expenses, and SBA 504 loans for property and heavy equipment. Depending on the type of loan you get, you could repay over 5 years, 10 years, or even 25 years. And the benefits are obvious: lower rates, smaller monthly payments, and more breathing room. But the trade-off is access. Banks want strong credit, detailed paperwork, and sometimes collateral or a personal guarantee. These loans take longer to close, but they're built for investments that last. Speed, cost, and cash flow show exactly how these loans differ. Short-term loans give you speed and flexibility, but they cost more and hit your cash flow harder. You're paying for convenience, and you'll feel it in those frequent repayments. Long-term loans give you more breathing room with lower interest rates and longer repayment terms, but they're harder to qualify for and take time to secure. They're about stability, not speed. So neither is better. It's about picking the loan that fits your situation. If you need money tomorrow and can handle the payments, short terms make sense. If you're building for years ahead and want predictable costs, long-term is the right move. If it's not clear whether you should take a short-term loan or a long-term option, this checklist can help you decide. Purpose. Do you need a quick fix or do you need a long-term solution? If it's a gap you can cover quickly, think short-term. If it's an investment that contributes to growth or long-term stability, look to long-term funding. Cash flow. Crunch the numbers. Short-term loans are fast, but payments can be brutal. Can your business handle the higher outflow? Long-term loans have lower rates and longer terms, but can your business handle the extra monthly payment over time? Cost versus urgency. Timing matters. If an amazing opportunity pops up or there's an emergency, the speed of a short-term loan may be worth the higher cost. If your need isn't urgent, a more affordable long-term option is the better choice. Borrowing requirements. If your credit or financial history isn't the best, short-term and alternative lenders might be the practical path, at least until you're able to qualify for better long-term rates. Hidden fees and structures. Some short-term loans have daily factor rates that add up fast. Long-term loans might include prepayment penalties if you pay off early, so always check the actual cost of borrowing to make the best financial decision. So let's put this in real terms. Scenario 1, a retail shop needs funds to buy holiday inventory that'll sell in 60 days. A short-term loan fits because the revenue will come fast enough to cover the high payments. Scenario 2, a cafe wants to buy and renovate a building. That's a long-term investment with steady returns. An SBA loan or bank loan is a smarter play because a loan term matches the useful life of the asset. When in doubt, lay it all out: cost, schedule, and risks. If the short-term loan puts your payroll at risk, it's not worth it. The bottom line is simple: match the loan to the problem. Use short-term money for short-term needs and long-term money for long-term growth. If you're clear on your purpose, your cash flow, and your timing, you'll pick a loan that fuels your business instead of draining it. When you're ready to compare your options, check out our picks for the best business loans for small business, where you'll find short-term options, long-term funding, and products to fit just about any need. It's linked in the description. Pick the right loan, stay in control, and keep your business moving forward. That's how winners do it. Thanks for watching, Mavericks, and I'll see you next time.